The last question is P14.9. Presented below are selected transactions on the book of Simonson Foundry. So we have 5 dates. What we need to do is to do the journal entry for all of the transactions. So we'll go one by one. July 1st, 2022. Bonds payable with par value of 900,000 which are dated January 1st, 2022 are sold at 112.290 plus accrued interest to yield 10%. They are coupon bonds, bear interest at 12%, payable annually at January 1st and mature January 1st to 2032. Use interest expense account for accrued interest. Okay, so we don't need to calculate again the present value because we have already the percentage sold, okay, 112.29. So we'll just debit cash, which is 112.29% times 900,000 plus half of 12% times 900,000. So this is the accrued interest. Yeah. So half because 6 over 12. Yeah, and then times 12% the stated interest rate, and then times the 900,000 the face value of the bonds. And then for the bonds payable is just 112.29% times 900,000, and then your credit interest expense 54,000, which is 6 over 12 times 12% times 900,000. So because the bonds is not sold at the date of the interest payable, so we must accrue the interest. Okay, and then for December 31st, adjusting entries are made to record the accrued interest on the bonds and the amortization of the proper amount of premium. Okay, so we will just debit interest expense, credit interest payable for the whole amount of the interest, which is 12% times 900,000. Yeah, because we have accrued for the first 6 months, so we need to accrue record the interest expense for the whole 1 year. And then for the amortization, okay, because this is premium, you will debit bonds payable, okay, credit interest expense. The calculation is 6%, yeah, times 6 divided by 12 times 12% times 900,000. This is the cash pay, yeah, and then you will minus the interest expense, which is 6 over 12 times 10% times 1,010,610. Okay, so basically it's just a cash paid minus the interest expense. Yeah, and you will get the amount of 3,469.5. Yeah, so you can just use the data above if you want. And then for the next one, January 1st interest on the bonds is paid. Okay, so you will debit interest payable, credit cash 108,000. And then 2nd of January, bonds of par value of 360,000 are called at 102 and extinguished. Okay, so when we want to extinguish our bonds, we need to calculate the gain or the loss. Okay, so of course we have the reacquisition price already, 102 times 360,000, which is 367,200. And then we need the carrying amount, yeah, of the bond. So we need to portion the bond because only 360,000 that will be extinguished. Okay, so we use the first carrying amount minus the amortization 3,469.5, and then you will times 360,000 divided by 900,000, yeah, which is the portion that will be redeemed, okay, or extinguished. So the net carrying amount is 402,856.2 because the reacquisition price is less than the carrying amount. Okay, so it will be gain on redemption or gain on extinguishment 35,656.2. The journal entry will be debit bonds payable 402,856.2, credit cash 367,200, and credit gain on extinguishment of debt 35,600. 56.2. And then December 31st, adjusting entries are made to record the accrued interest on the bonds and the proper amount of premium amortized. So for the accrued interest, okay, it won't be the same anymore because our par value has been decreased by 360,000. So the interest that we must accrue is 900,000 minus 360,000 times 12%, which is 64,800. Yeah, so debit interest expense, credit interest payable 64,800. And then for the amortization, okay, it is again the cash paid minus the the interest expense. Yeah, so the interest expense you can calculate it by using the very beginning carrying amount minus the previous year amortization, okay, and then minus the carrying amount that has been redeemed for this year, okay, and then times 10%. Okay, so you will get the amortization, debit bonds payable, credit interest expense 4,371.57.